All right, fantastic. Thank you so much for being here and settling down slowly but surely. We're about to go into our last keynote here until the coffee break. So super exciting conversation to come from emerging crypto trends from Maartje here from Messari. So let's give her a round of applause and welcome her in. Thank you.
Thanks. Okay, well, thanks for having me here, and thanks for coming to my talk late on Friday afternoon. Home stretch, coffee is inside. So my name is Maartje Bus, and I'm head of research at Messari. Messari is a data analytics and research firm. You could kind of like loosely think of us as an S&P or a Bloomberg for crypto. We've been around since late 2017. And yeah, research is in our DNA. So we do a number of different types of research, and research also goes into some of our software products. But what I'm going to be talking about today has to do with our thematic research that is for our subscribers. And I'll skip this, but we do in the interest of time. But we do a number of different things. So very quickly, we try to be early to narratives. Sometimes we try to quantify these narratives, so put a number on it, how big the potential opportunity is. We try to explain new technologies in an accessible way. We try to stay close to the beat of the market, and we uncover deep data-driven insights, which users find in particular useful when it comes down to traction, for example, of protocols. So I was initially going to talk about 7 emerging crypto trends, but then I quickly realized that that's a lot for 20 minutes because I would like to put a little bit of meat on them at least. So I cut it down to 4. The intersection of AI and crypto, SocialFi, also previously known as Decentralized Social, the next DeFi Yield Meta, and real-world assets. None of this is financial advice. You should do your own research, obviously. And these, by the way, these are all things that we see unfold or become like big things or continue to big things over the next 6 to 12 months. We actually have a report that came out today where we talk about these and a couple of other ones. So if you're a subscriber, you can access that. If you're not, it will be pro content in a couple of weeks, and then you can subscribe to a trial and get it for free. So with that, the intersection of AI and crypto. So what is that, right? There's obviously been a lot of buzz about AI and crypto. I really like this simple framing that I got from a paper in the University of Oxford, which is basically saying, well, AI and crypto, you can look at it from 2 different ways, right? One would be crypto helping AI, and the other one would be AI helping crypto, right? And you see a couple of examples of each of those here. What it's specifically not is AI and crypto living side by side in the same product without having any interaction with each other. So what I'm going to be talking about is the intersection of crypto helping AI, and there's a lot to potentially unpack there. You can see some of the stuff on this slide. I'm going to be talking about the stuff that has the stars in front of it, again, in the interest of time, and 2 areas that are either getting traction or that we find particularly interesting. But if you think about crypto, right, at a high level, in essence, crypto is solving coordination problems, right? So it is a mechanism to align resources, so monetary resources, people, and compute to create open source software. And you can apply this same thinking to AI and to AI agents in particular. So an AI agent can execute complex workflows autonomously, right? So you can think of it. You may have seen ChatGPT agent, right? What it effectively is a bunch of prompts. It's oversimplifying it, but a bunch of prompts packaged together to do something more complicated, right? So what people are thinking is as AI is making progress, that you're going to start, that first of all, these agents are becoming more specialized. So they're going to be really good at something, right? And what you're going to see then is marketplaces for AI agents, and where AI agents go to these marketplaces and buy the services of other agents to, do whatever they're doing, right? But go to others for what they are best at. And they obviously need payment rails for that. And we think it's very likely that those are going to be crypto payment rails because of the permissionless and trustless nature thereof. And furthermore, what we also think is that these AI agents are going to be using DPINs for other resources, so decentralized physical infrastructure networks, for example, bandwidth, storage, and then finally, I'm sure you've heard about it, I heard it a couple of times at this conference, decentralized compute networks, right? So again, these are like DPINs. So GPUs and compute is in general is the lifeblood of machine learning. And what we've seen is as ChatGPT rose in prominence, that there was soon a shortage of like GPUs. NVIDIA obviously has massively benefited from that. So what these projects, these decentralized compute networks are looking to do is basically crowdsourcing compute from different sources all over the world, and then renting that out to AI projects, right? Again, this is like relatively high level, oversimplifying it, but that is something. So projects like Akash and Render and IO.net have been getting a lot of attention, over the last year and more recently because of this. Doesn't mean that they're necessarily there yet, right? You can imagine as you throw all these resources from different places and of different types together, there's some work to be done there, because for example, if they're located all over the world, that's reducing like latency, which isn't good. So there's a number of problems to be solved there, but it's definitely a space that is making progress and that people are excited about. SocialFi. As I said, formerly also known as Decentralized Social, which is now kind of like a subset of SocialFi. Now, we all, well, most of us probably use social media, and we all love to hate social media, right? Because they steal our data, they manipulate us with their algorithms, and these are closed systems, right? And what that basically means, if you're on Facebook and you leave Facebook, you're going to lose everything. You're going to lose your pictures, your posts, your contacts. So what Decentralized Social tries to do is to break apart the tech stack and the social media tech stack, and in particular, the social graph. So the social graph is what houses all your profile, your content, your relationships, and the connections between those. And that is really great for both users and builders, because as a user, that means that your data becomes portable and you can take it somewhere else, or you can plug it into multiple sources at the same time. So the contacts that you have on Facebook, you also have them on Twitter and on LinkedIn, right? And from a builder perspective, it means that anyone can build on top of these graphs. Another thing that is not that great about traditional social media is that creators really don't get paid a lot. You really have to be the cream of the crop, like the top, like, I don't know, 5 or 10%, whatever it is, that actually can make a living from that, right? And these numbers are a little bit old, but still work to illustrate that. So if traditional social platforms own over 230 billion of market value, creators only earn 7 billion. Now, that is a big enough pain point and something that isn't fair that people are going to care if you can offer an alternative system there. So However, despite all of this, who needs like a Twitter on crypto rails just for the sake of it, right? I mean, too painful to move over there and to start all over again. So what we wrote when we initially wrote about decentralized social about 18 months, or maybe it was 2 years ago, is in order to see like meaningful traction with these decentralized social platforms, you need to see crypto native features that are actually useful to users. Now, and we're here. So welcome to the feature experimentation phase. And we basically see 2 buckets of innovation. One is at the primitives layer, the social primitive layer, so basically the social graph. You may have heard of Farcaster. Farcaster is a social graph, a decentralized protocol. And they also have a front end, Warpcast, but others can also build front ends on top of them. And they launched a couple of really interesting features this year that got users really excited, and they saw a lot of traction on the back of these features, on a very high increase in users, and they just raised $150 million from like all the prominent VCs as a result. The second aspect is financialization. So what that does, these protocols basically add a tradable component to social activities and profiles, which then basically allows, and I'll go into that in a minute, allows creators to bootstrap revenue, as they build out their following and have enough of a following to earn from traditional social media resources like sponsorships, like subscriptions. Now, Friendtech added a token. It's a social app, decentralized social app. They added a token which they called a key to each user. And what started happening is that users started trading these tokens, these keys, basically speculating on the future prominence of the user/creator. And so over the course of like just 3 months, Friendtech generated $50 million in platform fees that were split 50-50 between the platform and the creators. And now you may say like, and you may say like, well, you may poo-poo that, right? But if you think about it, that type of speculation is not very different from what VCs do, right? So VCs, what they basically do when they finance, for example, software companies, is they pay for the salaries of the engineers until they have a proper product. It may never happen, and they can basically do it on their own, right? This is kind of like what this is also doing. So they kind of get money from that speculation on, that they are going to be big, that they are going to work, and they use that to bridge that gap until they can stand on their own. And what is also interesting about this, money talks, right? And a key aspect of social networks is that things can go viral. So the two of these together, we think that, and combined with the traction that, for example, Farcaster has been seeing, we think that that decentralized social or SocialFi, that's going to be a big thing. And yeah, you already see some VC money going into that. Yield metas. In its short history, DeFi has consistently supported a yield meta. Now, what is a yield meta? A yield meta is a source of, disproportionately high yield, so to the tune of like 15 to 20%, consistently over a period of time, over a large enough pool of capital, 1 billion plus. Right? So that started during DeFi summer with liquidity mining, and then there's been a couple of others. You may have conveniently forgotten about Anchor, which was part of the Terra Luna ecosystem that paid like 20% yield on stablecoins, and everyone wondered why. And then most recently we saw Eigenlayer, right? And the Eigenlayer yield meta ended with the launch of the token. Now that begs the question, what is the next DeFi Yield Meta. And we think that it could be MakerDAO. And I'm gonna oversimplify this, so it's not doing it justice. But you can think of MakerDAO kind of like as a conglomerate, right? So they have like different products in there. For example, lending, an RWA. And so what Maker is doing to future-proof their organization, and they basically spinning off these products as sub-DAOs, single product sub-DAOs. So there's a lending DAO, there's an RWA DAO, sub-DAO. There will be a ton more in the future. These are actually of a specific type called allocator DAOs. And all these DAOs are going to have a token, right? So, and people that stake assets in these sub-DAO protocols are going to get tokens. So that's where you're going to start to see like yield farming, traditional DeFi yield farming opportunity. Now, why we think these yields are going to be amplified is because we think you're going to see a re-rating. So again, the analogy of a conglomerate, MakerDAO has been trading at a discount compared to RWA protocols or lending protocols. As these products become like pure plays and you can then compare better to these type of protocols, we think that's going to be a re-rating, right? So and that's going to amplify the yields, and therefore we think that MakerDAO will be the next yield meta, not financial advice. It may already have played out to some extent. Finally, everyone's favorite topic, RWAs. I'm assuming that everyone here is familiar with it, but real-world assets, aka tokenization, RWA protocols bring off-chain assets on-chain. So asset tokenization has obviously fascinated crypto and TradFi for quite a few years now. And this year, or over the last 12 months, we've seen a growth in TVL. I'll talk about that in a second. But first of all, why now, right? Why do we think that, tokenization is going to be a big thing this year? Well, first of all, because we're in a rising yield environment, and we've gotten to a stage where some of these off-chain yields being brought on-chain are going to be higher than the on-chain yields. Right, so it's just an alternative source of yield on-chain. And second, because some really big and important institutions like BlackRock with their BUIDL product and like Franklin Templeton have been coming on-chain, and we all know that everyone's going to have FOMO about that, right? So more of these will come on-chain, and there's going to be more hype and excitement around it. Now, and we're talking about, so if you think about it, a stablecoin is effectively also an RWA, right? It's a tokenized dollars. We're not talking here about centralized stablecoins. So, but if you look at the RWA of everything else that is non-fiat-backed stablecoins, it has grown from about 2 billion a year and a bit ago to like 8 billion right now. And so what we wanted to do is we were curious to see, where, when you segment it, where that money is actually sitting. So the way we chose to segment it is in two different ways. So first of all, yield versus non-yield bearing. So yield bearing being you bring treasury yield, for example, on chain. Non-yield bearing meaning, for example, tokenized gold, right, or tokenized real estate. And then second, the second segmentation is by the type of exposure that the end user is having. Is it effectively a debt instrument, or is it effectively an equity instrument? So debt instrument being, okay, so I'm staking assets, I'm getting yields in return. Equity being, I'm also, in addition to yield, I'm also exposed to the price movements of the underlying asset. So that's basically what these tokenized funds are doing, like Superstate and BUIDL that you see there in that corner. So, what do consumers actually want? First of all, let's look at yield-bearing RWAs before we looked at debt versus equity. So, Yield-bearing RWAs hold an 84% share of the RWA TVL. And what is especially interesting to me about that is when you look at everything that is excluded. So there's about 1.2 billion that is not yield-bearing. And all but 211 million of that is tokenized gold, primarily Tether. So that only leaves $211 million left. 85% of that is tokenized real estate. Then, I don't know the exact percentage, but then a whole bunch is private equity. And the rest, so i.e. only a tiny little piece, is everything else. You know, possible reasons, you know, KYC limitations, and also, you know, if you think about it, crypto is kind of seen as an alternative asset, right? So everyone that's on-chain obviously owns probably a lot of crypto, so why would they want other alternative exposure to other alternative assets? Anyway, I'm not saying that that's the case, but like, that's what we came up with. Now, finally, also my last slide, among the yield-bearing RWAs, debt instruments hold a 70% market share, and that's primarily driven by adoption of RWAs like MakerDAO and Ethena. Potential causes, again, KYC flexibility, but also preference for plain yield over a yielding asset. You know, it's basically a simpler UX. And then finally, if you think about it, that on-chain users tend to chase the highest returns, even if it comes with additional risk, then, you know, you have Ethena and you have MakerDAO, but you also have like normal traditional stable coins, right? That you can stake somewhere and get a yield. So that's also what these equity tokenized funds then are competing with as well, right? So anyway, that was everything that I have to say. If you, do subscription research. So if you're interested in that, check it out. We do like free 7-day trials or so, I believe. And yeah, thanks for having me.